Mihir Shirgaonkar, who is joining us from Phillip Ventures to talk more about markets. Mihir, first of all, want to understand your hypothesis for Indian market right now, because Indian market, did kind of underperform versus the world for a brief period because we had run up a whole lot. Some of that is getting adjusted. So, what's your hypothesis right now for the Indian market?
Hi, very good afternoon. Thank you so much for having me. So Indian markets, definitely we saw last year, how resilient they turned out to be vis-a-vis the global markets. And yes, there has been some bit of a correction, but the house view is that things are, definitely looking positive here onwards. Especially, if you look at the last year in 2022, world markets were extremely volatile, especially because of reasons like persisting decade-high inflation, the Russia-Ukraine conflict, maybe pressure on the supply chains as well. So given all these factors, we can see the overall world markets are recovering and the India story remains particularly strong going forward.
That is true, but we operate in a relative world. Do you think that India valuations have got sufficiently, adjusted versus the world, and the next couple of quarters we can start performing well again?
Sure. So, just to give a brief background about us. So, I manage the Global PMS, where I'm looking at largely the US markets, the European markets, and of course, tracking the India markets as well. Definitely, there has been some bit of correction. And our view is that going forward, there could be some volatility in the Indian markets as well, particularly the next 6 to 8 months. But overall, if we see from a very long-term point of view, valuations are reasonable, and it is a very good opportunity to actually start allocating towards the long term.
Let's understand your thought on the mother market, which is the US market globally, especially after the PCE data, the kind of PCE reading come in slightly slower than what the street is estimating. Do you think that this outperformance will continue of risky assets, mainly stocks there in US?
Sure. So the way we look at it and the way the global investments team is analyzing the markets, okay, all through 2023, we are expecting the markets to be dictated, essentially by three factors. Number one, the trajectory of inflation, how inflation prints will be, subsequently, both the CPI as well as the PCE. Number two, the consequent monetary policy action by the US Federal Reserve. And of course, number three, what will be the impact, especially of a higher interest rates on the earnings? So with this backdrop, we really believe that the next 2 to 3 quarters remain extremely critical because the impact of higher interest rates on the earnings should be visible now. And that will really give a sense of, whether there is a slowdown or if at all there is a recession. But overall, if we see, particularly technology in the US, there has been a lot of correction. And our hypothesis, the products that we are offering, we really believe that it is a very good opportunity to start investing in the US markets, particularly the technology space for a long-term horizon.
Yeah. In fact, technology is kind of leading the rebound out there. And a good correction has actually happened. A lot of Indian investors are interested in the US market, the technology part. Tell us, how is the quality of earnings do you see, or even valuations? Because technology on NASDAQ for indicative purposes actually topped out when rate hike cycle started in US. Now that the pause or rate cut cycle is likely to be, which lies ahead, do you think this outperformance of NASDAQ and technology stocks will continue in US?
So definitely, the way we look at it, a higher degree of outperformance could perhaps happen when there are actually rate cuts in the US markets. But given the current information, we believe that rate cuts in the US markets could be at least a year away. Right now, we are in a situation where the US monetary policy is towards the fag end of its monetary tightening. There could be some more tightening because, as I mentioned, inflation has definitely eased, especially since its last year high, but it still remains at elevated levels. So to that extent, there could be some bit of volatility for technology. But we can fairly expect that it may not be as volatile as we saw in the last year. So, yeah.
How are you reading other macro indicators there in US beyond, just the inflation? Things like shelter, rents, fuel, energy, and now with crude oil price hike, is there a risk that inflation may remain elevated for a prolonged period of time?
In fact, thank you so much for asking this question. If we really look at the construct of the CPI, a major chunk of it is actually related to housing and shelter costs. So those are the kind of metrics that we are really monitoring. Of course, fuel costs and all those other things remain critical. But how the housing prices are really shaping up could really have a major impact on where the inflation could go from here onwards. And that is something that we are really closely monitoring at the Global Investments Desk. Yeah.
What are your thoughts on this crude hike, as in, as a part of overall element of, hypothesis for equities globally? Because this came out of the blue, the production cuts which you have announced, and hence the resultant hike. And also, if you have an eye on geopolitical as well, do you think now that the production cut has been done by OPEC, non-OPEC players may actually go ahead and, hike their output? Why I'm asking you is this, because after all, crude or energy is also a key ingredient in inflation calculation globally.
Absolutely, absolutely. So the way I would like to take this question is that very recently I finished reading this book, The New Map by Daniel Yergin, and which really talks about the dynamics behind the energy markets across the globe. Now, definitely in the Middle East, one of the insight from that book that we got is that nations in the Middle East definitely, craft up their budget depending upon a certain level at which the crude is. Maybe, okay, I can't be very sure about it because this is an information which even we are digesting as we speak. So one of the reasons for that could be, they would really like to, ease some of the pressures on their budget. And that is the reason there could have been some bit of hike as well. Maybe the non-OPEC nations could also follow, maybe not. It will only be evident as to how it really impacts the earnings of companies.
All right, Tami, thank you very much joining us on the show today.
Thank you.